Is it time to buy bonds with interest rates at near 15-year highs? It's a question that we're hearing a lot more. Let's take a look. Hi, my name is Eric Blattner with Divvi Wealth Management, and thanks for watching. Before we get into the conversation around bonds, first I'm going to ask you if you enjoy the content that we provide and some of the thoughts that we share around markets and planning and things of that nature. Please follow along. Go to divviwealth.com, D-I-V-V-I wealth.com. And on our blog page, you can sign up with your email address to have our thoughts and insights shared directly to your inbox. Or you can head over to YouTube and search for at Divvi Wealth Management and subscribe to our channel there as well. So with that being said, let's talk about bonds. Interest rates, I'm sure you've noticed, are considerably higher than really at any point over the last 10 or 15 years. You have to go back to basically the mid 2000s to find a 10-year treasury yield that is roughly at the same level as what we see today. So recently we even got to a 5% yield on a 10-year treasury. Shorter term maturities, we've talked a little bit about the inverted yield curve. Shorter term treasury bonds have actually been north of 5% for a little while now. So it does beg the question, are bonds a good buy? And I think we wanted to at least share a couple different ways to view that question. There's always some nuance in the answer, and so perhaps framing it along the lines of income, diversification or protection in the portfolio context, and then finally just a look at relative returns might help for people that are asking themselves that question. So first, let's look at the income component. Now, this is probably the most obvious statement that I can make, but one of the implications of higher interest rates is higher interest rates. So for loan investments like bonds, investors are able to generate a stable, steady, reliable return around 5% without taking a lot of stock market risk. And they can even buy corporate bonds from very high quality companies, those that are rated AAA. Those are generally considered the highest quality borrowers, and those folks are paying about 5.3% on their corporate debt. Or if you want to dip down in quality a little bit further and still stay investment grade, those are basically triple B rated bonds or better. You can get north of 6% on those bonds. So from an income standpoint, it's really easy to see why these levels of interest are pretty darn attractive. Savers for, like I said, a decade and a half now have really been struggling to earn any type of reasonable return without taking some type of stock market risk or credit risk or things of that nature. And today's environment is very, very different. So for folks where a 5% return might get them to where they need to be, from an income perspective, bonds are as attractive as they've been in a really long time. For those types of individuals, you might not need to introduce any other types of investments into your portfolio. So that's kind of how we would think about it from an income perspective. Now, what about diversification? A lot of folks think about bonds as the other side of the equation for stocks. So if we're investing, we're building a portfolio. We understand that stocks, there's going to be short-term ups and downs, and a lot of times we will own bonds to try to reduce the overall volatility of the portfolio. And I think one of the important pieces to keep in mind is that stocks and bonds, at least for most of the last 25 years, have had a negative correlation. And so we will start first by looking at this correlation chart. And what I mean by correlation, if you're not up to speed on a lot of stats, or if it's been a few years since you've sat through a stats class, this is just the tendency for two things to move in the same direction at the same time. If there's a positive correlation, that's the green bars in this chart, that would seem to indicate that stock prices and bond prices are moving together, either higher or lower, at the same time. In this chart, the orange bars would indicate that stock and bond prices are moving in different directions at the same time. So those are negative correlations. And we're looking at 2-year periods here. So really over the course of the last 40 or 50 years, we've seen some of both. Bonds are not always negatively correlated to stocks. And so when we think about them, kind of there's been an adage that's generally held true for the last 20 or 25 years that when stock prices are struggling, bonds have generally done better. And one of the things that we've been thinking about now that interest rates are a little bit higher, what happens if we go into a recession or some type of softer economic environment? The typical policy response is for the Federal Reserve to cut interest rates to try to stimulate economic activity, try to get the economy growing again. And so when we think about how this occurred in the mid 2000s, they couldn't really take rates below zero, which is where they were effectively. Now, other countries actually did take interest rates below zero, but in the US, we have had a positive interest rate from a Fed funds perspective since the Federal Reserve has existed. So now that interest rates, the Fed funds rates in the low fives, low to mid 5% range, they have more wiggle room to essentially cut rates to stimulate growth in those softer environments. What does that mean for bond investors? Now, there's generally two components that we think about for a total return for the bond. There's the income, the interest payment. That's one piece. That's pretty easy to calculate. And then there's also the price movements. So prices and bonds will move up and down. You've probably seen the teeter-totter analogy a million times, where when interest rates rise, bond prices go down. And when interest rates fall, bond prices rise. So that's generally the trade-off that we make with high quality bonds. And so if we think back again to those recessionary environments where the Fed might be cutting rates, where interest rates could be falling, that could provide a little bit of a boost for bond prices and help offset some of the risk that's on that equity side of the portfolio. So from a diversification perspective, it seems like it might be a better starting point for high quality bonds as well. One more caveat is that there's generally two types of risks that we think about with bonds. There's the interest rate risk, which we just talked about, and then there's credit risk. So I'm going to spend one more second on interest rate risk. Here's a chart that shows rising interest rate environments from the last 10, 20 years, maybe a little bit further back than that. And it shows different investment types and how they performed when interest rates were rising. And so, those high quality bonds like US Treasuries, those AAA bonds, generally are very sensitive to changes in interest rates, much less sensitive to changes in economic growth. So those are generally the bonds that are going to perform best in a falling rate environment. And when we think about the second risk, credit risk, these are bonds that are issued by borrowers who may be a little bit more economically sensitive. So if we go into a recession, they may have a harder time making those interest payments or paying back the principal payments. So we say that because we want to go eyes wide open when we are buying bonds to offset equity risk. Or if we want bonds to play a very specific role in the portfolio, we want to make sure we're buying the bonds that are exposed to the risks that we intend. So hopefully that makes sense. So again, from a diversification standpoint, I think there's a reasonable argument to be made that higher interest rates should provide at least some better opportunity to offset equity risk in those softening or economically weak environments. And then lastly, we want to think about just the returns, the relative returns for bonds. And we went back and we looked at 10-year periods for the starting yields and the subsequent return from a 10-year Treasury bond index. So in this chart, you'll see the starting yield is the orange dot, and the subsequent 10-year return for the index is the green bar. Now, stock returns are notoriously difficult to predict, especially in the short run. But bond returns, the starting yield is actually a pretty good indicator of what folks can expect to return or earn over the life of the bond. So in these cases, it's not a perfect indicator, but it's decent. It's good enough for us to pay attention to it. So you'll notice that those orange dots through most of the 2010s were very, very low. And now with the starting yield of near 5%, bond investors should expect a better return going forward. And you may be asking the question, how does that compare to stocks? So in this chart, we use the exact same data, but we now include the 10-year return for the S&P 500. And as you might expect, when you have a longer time horizon, stocks historically have performed better than bonds. It's not always the case, but generally speaking, longer time horizons have tilted the scales in the favor of equity investments, stock investments. So there were 5 examples where that wasn't the case. And we had a very poor starting point in hindsight for stocks in 1999 as the tech bubble grew and then eventually burst. 2002 was a very challenging environment for a lot of stock investors. And then, of course, we had the global financial crisis from late 2007 through early 2009. So 2 of the most severe recessions and stock market drawdowns happened during that 10-year period. So 4 of the 5 periods in which bonds outperformed stocks happened to fall during that decade. Um, we say all this because, again, we think it's important that as investors, we prefer to allocate based on, at least to a certain extent, the expected time horizon. So if you think you have a long time to wait, we think you should probably have a long-term investment strategy. If you have some short-term needs, those goals probably deserve a short-term investment strategy where there's more certainty, more stability, and less equity risk. Hopefully that makes sense. So if you have any questions, there's a link down below in the comments. If you're watching this on YouTube, please feel free to reach out to the Divvi team, schedule a call with us. We'll be happy to talk more. And again, I remind you, if you enjoy hearing our thoughts, please do us a favor and go over to divviwealth.com. That's DIVVI wealth.com and sign up for our blogs to receive our weekly emails. Or you can subscribe to our YouTube channel right here to get notified anytime we post a new video. Thanks again for watching, and until next time, have a great day.